Good evening. So tonight we're going to make a little bit of a different video with a different topic. I was watching Nicky is his name, a Russian fellow who is in Vietnam or living now in Vietnam. He shared on his channel just a few days ago how much money he was making with his YouTube videos. And he pointed an interesting fact out that YouTube itself is interested in YouTube content providers providing content about finances, financial stuff. And I have a background in finances. I lived in New York City for a while. I went to Pace University and I majored there in international business management. And I have worked in this field, and of course, for my family history, we have owned a wide variety of businesses, and we had trusts formed and all sorts of stuff. So with that, I'm in a very unique position to probably explain some basics about wealth and wealth creation, of what that actually is. And if you are a younger viewer, you may have wondered on how people get rich. The first questions we actually have to ask ourselves: what is the definition of rich, and what is the definition of wealth? Because both of these terms may have completely different meanings to different viewers. And I want to give you an example. Let's just say I have zero money, $0, zero pesetas, zero pesos, zero rubles, zero nothing. 1 ruble is more than zero. 10 rubles is more than zero. $1 is more than zero. $10 is more than zero. $10 in comparison to $100,000 is nothing. It's close to zero. But if that person absolutely has nothing, they will be able to buy something for $1 or $10. So, and of course, the person who has $100,000 probably can easily give $10 or $1 to someone else who doesn't have anything. This video is not going to be about the redistribution of wealth, but this gives us a scale of how we actually have to measure wealth and riches, or being rich, of what can be perceived of being rich. And that really depends upon the individual. We have people today in our world who are richer than ever before, and that number has grown, and we have them all across our globe, thanks to globalization. People who are worth several hundreds or several tens of billions of dollars, hundreds of billions of dollars. And those are the ultra wealthy elitists, you can say, who have gotten to this point, and every story of them, is documented down to the last detail on how they came from wherever they came from and they went to. Whether it is Bloomberg in New York City, it is Bill Gates or Elon Musk or the guy from Amazon or Siemens or the old guys, the Rothschilds and those people, and JP Morgan and whoever there was, the railroad barons, and how they made their fortunes. Those things are all very, very documented. What is not really documented is probably the group of people where their net worth is somewhere between, I would say, 10 million to $1 billion, because you really, out of all these lists from Forbes and whoever else keeps track of money. I got myself some water here today because I kind of dry up a little bit. So that is the first question we have to ask ourselves: what actually is wealth? How wealthy do we want to be? For most people, I would say, I guess, we're born, we grow up in our environment we grow up in, we attend the schools we attend, And then comes the decision at in your late teens, early 20s, do I go to college? Do I get a job? Do I go and do an apprenticeship? And, you're looking at what I like doing, and do I want to work for someone else? Do I want to work for myself? Do I want to run my own business? Where most people are going to wind up is they're going to get a job, or they're going to go to college to get some better training and have a degree, or they go to trade school and then they go on from there. That is the great majority. Some people will stay in it, some will start their own business. The electrician who went to the journeyman school, or the apprentice school for electrician, may become a journeyman and becomes a licensed master electrician, and then starts his own business, electrical company, doing whatever electricians do, wiring new homes, or, general construction and that sort of stuff. And they can become quite wealthy by any means in that, and they can generate a pretty good income. And I want to give you an example. I live in Kansas City. When you make $100,000 here, net, whether you own business or you're employed, that $100,000 will buy you a better life here than if you make $100,000 in San Francisco, Los Angeles, New York, Chicago, or probably even in Miami today, in these very expensive cities. So it all depends. $100,000 will barely get you situated in New York City today with the inflation and everything else what we have. And in other parts, you can live very comfortably on $100,000 income. And I didn't want this video to become a video and say, well, you have to invest in Bitcoin. Tomorrow the world is going to end and you will find yourself out of a job because of the AI stuff, because they're going to get rid now of all the people because in the offices, to do clerical work and that sort of stuff. That's I don't want to make a video like this. What I want to explain in this video for the viewer who is not familiar with this is there's a certain amount of mysticism about wealth. And like I said, it's a matter of definition. How do we define wealth? Wealth is the equation in net worth versus liabilities. That means the amount of credit card debt, housing debt, mortgage debt as a private person gets. Now that's what I want to explain. Versus what you have in the bank, in cash, what you have already purchased and own outright in terms of property, whether it's vehicles or airplanes, boats, homes, land, all that stuff, stocks, all the financial products available. That is the comparison. So that's just where it starts. So you can have someone, so if you make $100,000 and you live very frugal and you have no credit card debt and you're able to save over 10 years, say like you save every year $15,000, $20,000, just let's say $20,000, after 10 years, you're going to have $200,000 plus the accumulated compounded interest on this if it was in a traditional, invested into a traditional financial product like a savings account, which pays interest that compounds annually. You can get different products. I don't want to go into the exact details of what all these, products available. But that gives you an idea. So now your net worth is $200,000. You have lived probably quite well at this point, and you were able to save this up. That is your net worth. You keep doing this. If you could save $50,000 a year out of the $100,000 you're making, you're gonna be half to a millionaire. You're gonna have $500,000 in there. If you choose the correct financial products, you may be able to even get this doubled in a 10-year period, and you might be then already at $1 million with just making 100,000, so you have become a millionaire. In the financial world, a accredited investor is when you reach this level, there's a definition to this. You have to have a net worth of $1 million, or you have to have disposable income of $250,000 a year. Disposable income means anything in excess to what is necessary to pay for your housing, foods, transportation, clothing, taxes, and all of that stuff. That is the definition which the financial market uses to assess the worthiness of a potential investor for particular investment products. That's the best way I put it. Any person can open up a online brokerage account, say like with E-Trade or Schwab or Ameritrade, I think is one of the other ones, and you can purchase stocks there, you can purchase ETFs and that sort of stuff. There are certain financial products, and that is usually the ones which revolve around a higher risk, or the ones which cannot be easy liquidated, which we call that, turned into cash. A stock I can buy right now, and 5 minutes later, 10 seconds later, I say I want to turn around and sell it and just execute a sale order, and I got rid of them as fast as I bought them, basically, with a loss or with a gain or break even. In certain financial products, we call them alternative investments. There are criteria before a broker can legally sell you these securities or recommend them to you. You have to meet that. Again, that is $1 million in net worth and $250,000 in disposable income. And then you are deemed to be a person who can invest money, who can sustain losses in the financial market. So this is like the entry level requirement to what we would call, well, at that point you would have moved yourself into the upper 3 to 5% of the world population when you have gotten to this point. And you're not in the top 1% or 0.1, when you're in the top 3% or 5%. And that is the entry level. And that is where the masses separate itself from what we in the United States consider to be wealthy. A person can be rich in knowledge. You can be rich in resourcefulness. There's a lot of different ways you can be rich. That's why we don't like to use the term rich, but we use the term wealthy. And now we have entered, so we have cleared this now up. So this is the objective, is to get to this level where you are considered by the financial market as a wealthy individual. When you meet that lithium test, basically whether or not you can enter or you have entered and you qualify as an accredited investor. That is similar to almost joining a golf club, a country club, where they'll say, well, our annual fee is $50,000, $100,000, and you have to pay $250,000 or $500,000 to get in. That will keep all of the other people out, and with this you have bought your way basically into this. That is somewhat similar. It's the country club kind of strategy. So this is where this whole thing separates itself. No one here in the United States really cares on how you got to this point that you have achieved that level of wealth or to be considered wealthy. And as long as it is not, of course, done illegally, illicit, engagement in illicit activity, etc., etc. And of course, preferably without tax evasion involved in it. So any hint of illegality in this is not desirable or is not accepted. It's not very acceptable. As there was in the 80s and 90s really a lot of mysticism about this, and how do people get into this, and what kind of secret there was to get there, and what do these people actually know who would qualify into this, in this class of people. Even though we're living in the United States, we are a class society, but the definition of classes here is not in an aristocratic status sense, but it is by the amount of wealth the individual has accumulated, inherited, or built up themselves through their own success and work and all of this stuff. Now, once you get into this level of to be an accredited investor, this will open up the door to financial products which are not available to the general public. So we're going now into a class of financial products which have higher returns, which can make a lot more money, basically, or create even more wealth faster than the standard products available to the masses, basically to the regular people. And this is something which Warren Buffett understood when he started out. He understood the concept of wealth. He understood the concept of being an accredited investor, which has increased in the dollar amounts associated with the status since he started in the 1950s or 60s. And he understood the financial products available to him. When I say financial products, the Wall Street is basically an industrial complex. And Wall Street hires mathematicians, physicists, and they have created what they call financial engineering. And these people collectively engineer, say like at Goldman Sachs, at JP Morgan Chase, at these big places, financial products. And that means they're coming up, the ETFs is one of those brainchilds, electronic traded funds. Those came about in the late 80s. That was a new way of trading. And these are today available, because of the lower risk, depending on what risk they carry. Highly sophisticated financial products, for instance, are what we consider mezzanine loans. And I want to give you an example here. There was a company in New York City which was called KCAP Financial. And KCAP Financial had 8 employees or 9 employees. They worked on Park Avenue. And they formed a stock corporation. I think it was in 1990, 1991. They raised $100 million, and those $100 million were lent out to mid-sized to large-sized businesses here in the United States for different investments, for capital requirements they had to finance ongoing operations, basically. Long-established, low-risk companies. KCAP traded in the $5 to $10 range. It never went much higher and much lower, and there was a reason for this. And KCAP paid 12% dividend. So this was now a stock which 99.9% of the stockbrokers even didn't know that this existed. I owned them for a long time, and I had money invested in there, and that money paid me every 3 months out of 12%, so a quarter out of the 12%. And that is a very high return. And I had the stability here was that the stock prices stayed pretty much level. The executives and the owners of that, or the owners were the shareholders. In this case, we got paid through dividends. Dividend income in the United States is taxed at 12 to 15%. This is by far less if I would have made the same amount of money working. So I want to give you an example. For every $100,000, that stock generated $12,000 in interest payments or in dividend payments a year. You have $1 million invested. You will receive $120,000 a year, minus the 15% you have to pay. And if you look at, if you go out and you make $120,000 as an employee, you're going to be most likely in the highest income tax bracket, and even with deduction or alternative minimum tax, you will wind up almost paying 40% out of this to the federal government between Social Security and income tax and possibly state tax on top of it. The $120,000 out of the KCAP dividends are only taxed at 15%, and there's no state taxes. Not in Texas, or not in Florida, or not in New York. So now I did nothing. I didn't even have to get up in the morning. The people at KCAP all had to manage. What they were doing was managing the money they had lent out, and they were collecting that from large S&P 500 type entities with virtually no losses, because those were the General Motors and IBMs and those type of companies, Boeing. That's where they lend that money to. And this is basically the insider knowledge on how people actually, once you have a certain amount, you can invest, on how they actually investing this. We don't invest money into the stock market per se. We don't go into the IPO scheme. We don't go into this Bitcoin things. We want to have a qualified return on the investment as a dividend payment, where we don't have to pay a lot of taxes on. So I pay gladly 15% out of $120,000, and I'm done with it. I'm clear. I have done my deed, and I'm good to go. And so you diversify this. There's these companies, there's not very many. You have to know how to evaluate companies who do this kind of stuff. There's a few of them around. I will not tell you who they are. That is not a secret. But you need to do your own research if you want to find them. I personally would not buy a stock unless that stock is paying dividends and they have a track record of dividend, and the dividend payments are in equal amounts over a period of 3 to 5 years. That's what I can tell you. Then you have a stable income, and then you can decide out of that money, say like out of the dividend payments out of KCAP, which I could make a decision. Well, I need $60,000 to live. I've spent about $18,000 in taxes, so I got a little bit less than, I got $102,000 or something like this. So I have like $40,000, left over. I can now take that and buy more KCAP stock, for instance, for $40,000, and I'm going to get even more dividend payments. Then I'm reinvesting the dividends. That is what we would call a dividend reinvestment plan, where you figure out how much money do I need to live, to pay my living expenses, how much money do I want to reinvest to grow my net worth, and at the same time, when I'm growing this, how much more dividend payments am I going to get back. And the next year, my pile of leftover is going to be even greater, because I reinvested $40,000. Now I can reinvest $60,000 or $50,000, and then the following year. So you can grow this further and further. When you buy stocks, say like Tesla, which did not pay dividends, and now they're in a bind with selling discounted vehicles because of the competition and tax losses, tax incentives were lost for the consumers on this, then you have banking on only one thing, and that is the actual value of the stock going through the stock price. But you're not getting any cash coming in on your investment. Ownership is the key here. This is what we call it. And the ownership needs to see cash coming back at the end of the year or quarterly as it is paid out in dividends. The other vehicle which is available here, which is predominantly used in this, is the securities market, the bonds, corporate bonds in particular. Here you get a coupon payment every year. So it is a combination how you split this up at the same store. You can then buy more of the bonds when you get your interest payments. And now the money is working for you. When you invest into startups where there is no dividends or interest coming in on either one of those, they will not help you to grow your portfolio or your net worth the way cash payments as dividend or interest income do. There's nothing wrong with investing into stocks itself which don't pay dividends, but the strategy has to be very different in that instance. And once you have a certain amount of money, you will see this, that it is easier to create more wealth through dividend reinvestment rather than by trying to pick a stock which you believe is going to increase tenfold in value over the next 5 years. Say like you buy a stock for $25 and you anticipate that stock to be at $100 or $150 in 5 years or 10 years from now. Then you're basically projecting or you're gambling on this, that this is going to materialize. Rather than taking the money today or every 3 months, you're banking on the big pay date when this is going to materialize. And that is the strategy Berkshire Hathaway has followed after they started out building up a basis of net worth or wealth. Warren Buffett, when he started, was first through dividend reinvestment until it got big enough, and then he started to take fairly large amounts of money and he put them into corporations, banking only on the appreciation of the value on that stock over time. He did it in 2009, in early 2009. He went in and he bought Goldman Sachs shares. Goldman issued him preferred Class A shares for Berkshire Hathaway. I forgot how many hundreds of millions he put in there. It was a substantial amount of money. And those he purchased, he put $250 million in, I think it was, and they turned into $500 million or almost $1 billion in 6 years. So he took $250 million and turned it into $1 billion that way. That works under certain circumstances when you get preferential treatment, when a company is distressed, like Goldman was at the time, Goldman Sachs Goldman, because of the financial crisis. And so they played it that way. In general, the best option is just to combine these things. Gold is a debt value, so is silver, just as an example. They have no purpose other than to hedge against inflation. Because as more money, so to speak, is in circulation, as higher the value of the gold gets. Gold becomes more valuable because of the scarcity of it and the difficulty in mining it. But in essence, it is more or less a reflection of how the inflation is going. The same is with Bitcoin. Bitcoin, for instance, is one of these currencies we have. And let me just get them. Which bring in, or which have the same thing as what intrinsic values of gold or silver is, rare metals, is that the over time, as more has been mined, as more difficult it is to get more gold out of an existing mine. And that is the difficulty, or the same feature Bitcoin has built in. That means it becomes increasingly expensive to mine Bitcoins, the actual creation of Bitcoins. And eventually it will come to the day where there's no longer Bitcoin going to be created. That means whenever that day is reached, then there is only that much Bitcoin in circulation. That's why I'm not too worried about it, whether Bitcoin is currently at $15,000 or $50,000, because this is just a reflection of how people value this, because it is still being mined. Eventually the day will come, and it is not too far out, where there will be no more Bitcoins created. And then the value of it, or the exchange rate to the local currencies, is going to explode, because then there's only that amount of Bitcoins in circulation, and it will no longer increase. And we're getting to a point now, it just happened a few days or weeks or a couple of weeks ago, is that we have reached the next level of the difficulty in mining for it, which means you have to have even more processing power to actually mine it. I have gotten into Bitcoin a long time ago. I have all of my Bitcoins. I'm not going to sell them. And I'm waiting for the day with the Bitcoins, when the day comes that there is no longer Bitcoin being able to be mined, because we have come to the end of the system as it was designed in the first place. Most people don't understand this. That is the advantage of Bitcoin. Bitcoin, you have to be in for the long run, for at least another 10 to 15 years. If you have extra money floating around, you may want to buy it up. Don't be too worried about this. If you gonna spend now $15,000, $20,000 or $30,000 on a Bitcoin, and if that Bitcoin drops back down to $10,000, it is going to be erratic for quite a few years to come, until this thing has established itself fully. And as I said, is the difficulty is in the mining. And once you have a limited quantity of something, then only the demand of it will increase the value, and the demand will come for Bitcoin. And it is already there, and it will increase and intensify. That is my projection in it. So I'm in this for the long haul. I have been. And this is the only way you really can make money in the markets, is to be in for the long time. So now I have shared some things. One thing I wanted to mention, and that is what most people get into in terms of higher valued property, is real estate. You know, this is probably the biggest purchase most people do. Cars, for most people, are a means of transportation. They are not looked at as collectibles. The people who collect those, they put some money, they have extra money to spend, they put it in there, and they hope that they're going to appreciate in time and that sort of stuff. And the same with artwork and gold watches, or rare watches. And I mean, you can collect almost anything, stamps and everything else. But those are completely different, investment vehicles, what we would call this. And you can get into it or not. But for most people, the item they get is real estate. And with real estate, what you're trying to do is to get into it and to own this clear and free as quickly as possible. You do not want to carry mortgages for a long time. I would get a 30-year mortgage, for instance, because you can get the lowest rates, or not necessarily lowest rates, but you can get lower payments, and then you can actually increase the amount of payments you make, because the payments in the beginning of the mortgage will be applied to the interest first, so, and then to the principal. As more you can pay, say like your mortgage payment is $1,000 for your property, and you have a 20 or 30-year mortgage, try to pay, if you can, $2,000. And then you will get equity built up into your property a lot quicker, and that will bring your net worth up if you have to finance a property. The properties, or property in itself, well, if we're looking at it from a religious point of view, God made only so much land, so to speak. He made only one planet, if we believe that God made the planet. I leave that up to the individual, but just saying. So there is only so much land you can purchase, and as the real estate people say, location, location, location is everything in this. I would like to warn you, there is a, how should I say this, there is real estate people out there, they have found a way to create a very stable income for themselves. And what they do is they go out into rural areas, Tennessee, Oklahoma, here in Kansas, southern Kansas, and they buy up from, estates. Someone dies and there's an estate which needs to be settled. They buy these large properties up, 200, 500 acres, 1,000 acres, 250 acres. And these are usually the properties which have no real agricultural value. You can't use it for farming, you can't use it for dairy cows, you can't use it for beef cattle. But you could use it, for instance, to put a cabin up. So they're splitting up, they get 100 acres and they're making 5 20-acre parcels out of it. They get 1,000 acres, they make it even bigger. And then they go ahead, and that is usually undeveloped land. There's no roads, there's no sewage system, there's no electricity, nothing. It's basically out in the boonies. And they will come in and say, well, we sell you 20 acres for $25,000, just to take a number. It sounds like a good deal. And they give it to you for $100, $1,000 down. And then you make an arrangement with them where they owner finance this at 6%, 8%, 9%, 10%, whatever. And you wind up with a very small payment. However, when you read the contract, which I've looked into these things on how they're making money, is their scheme is very little money up front, virtually no equity on your end into your property, but payments now for the next 5 years in the amount of $250, $300, $500, whatever, in that range. And then what they call it, you're going to have a balloon payment left, because the note they carry goes for 5 years. So if you pay, say, $200 a month and you have a property for $25,000, then this is about $2,400 a year. Over 5 years is $10,000. Now you have a remainder of $15,000 left on the property. And what they do is then they're going to take that $15,000 and they're going to refinance this again. And then it depends on where the interest rates are. So if the interest rates say like double again because of inflation, we're at 5, of an average of 3.5%, 5% in that range, it could go up to 10%. Then your $250 payment will go up to $500, and you will have to pay $500 with 10% interest on those remaining $15,000 if you cannot make the balloon payment. Always be very careful with balloon payments on properties unless you know you have the entire cash balance, which is due at the end of the loan. These are usually the short-term loans, ARM loans, for instance, 2-year ARMs, 5-year ARMs, 3-year ARMs, or these type of notes which run from 1 year to 5 year. They all have a balloon payment, which is very hefty. And when the balloon payment comes due, you have two issues. If you don't have the money to pay that off, then you will have to find new financing. With these properties out in the wilderness, where you can put up basically a hunting lodge, a cabin, that kind of thing. With these, they're like in the range $15,000, $30,000, maybe $35,000. Sounds very attractive and is probably a great investment. But it is the long-term commitment in it, in the possibility of changing interest rates significantly higher. It also can go lower, but in the current environment we're in, it's most likely going to be higher. So you have to be careful with this. And the same with ARM mortgages for regular homes, no matter what the value is you're trying to finance. It's a very easily obtainable loan, but it can be a real big issue when that loan nears the end of its term, and that's usually only in a range from 1 to 5 years. Some of these ARMs are 7 years. Then you're going to find yourselves up on the spot trying to get the remainder financed within your income means, which may or may not be possible, or you're going to be out of it, basically. Then you have to do a fire sale on it in order to get rid of the balloon payment. And of course, if the fire sale is below the balloon payment, then you're first of all out of your entire equity, and you're going to be on the hook for the difference to the financing company. So this is basically it. If you think I should make more these type of videos, if you have particular investment questions or investment questions about financial products. Now, I'm not a licensed broker. I'm not selling any particular stock, so I gave you only general ideas here. But you can then post it in the comments, and then I'm going to take a look at this and see if I can have the answers for it. The other things I have done is I have a friend of mine in Cleveland. I lived in Cleveland for a couple of years, from 2011, 2012, right after the crash. He is a lawyer, and he's a FINRA arbitration lawyer. This is the lawyers who go after stockbrokers and financial advisors. And I did the damage calculations in these FINRA arbitration cases, which means I'm the expert. I'm looking at this, what my friend's client had bought as based on a recommendation of a stockbroker, licensed stockbroker, or licensed financial advisor, financial coach, as they call them today. And we evaluate then whether they made money on this or they lost money. And I'm the one who determines on how much they did make or didn't make. What they were told, whether they actually would qualify as a accredited investor, and that was the correct financial product they had obtained or not. Sometimes it happens that people who do not qualify as accredited investors and they sustain a loss, that they wind up with a financial instrument which is unsuitable for them, basically, and that's why they experienced the losses they did. That's basically on how this works. And so if there's any interest in this, otherwise I'm probably going to look at the Ukraine at one point or another. And if Svetlana is going to watch this, I did watch your videos, and I know now that you have a fiancé in the United States and you're coming to the United States. Whenever that is, I have no clue where you're going to go. I don't know, but the best of luck to you. You're probably going to be better off looking at your videos, and congratulations to your sister with her graduation on her degree. I think if I understood it correctly, it was architect. Yeah, so that's where that is at. So everyone else out there in YouTube land, you enjoy yourself and stay safe and we will see you again. Have a good evening.